Good afternoon, and thanks for joining our Higher Education Virtual Town Hall. As a reminder, the material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. This information is not intended to create, and receipt does not constitute a legal relationship, including but not limited to an accountant-client relationship. Although this information may have been prepared by professionals, it should not be used as a substitute for professional services. If legal, accounting, investment, or other professional advice is required, the services of a professional should be sought. Before we begin today's presentation, I'd like to go over a few housekeeping items. To ask our presenters a question, please type it in the Q&A window and hit submit. If we don't have time to answer your question, we'll follow up with you after the presentation. Finally, in addition to the information we'll be sharing today, Moss Adams has many resources to help you navigate COVID-19 and stay up to date on industry changes in the current environment. You can find links to these resources in the slide deck and handout widget to the left of the slide view. And now I'd like to turn it over to Melissa Harmon, Moss Adams Partner and Higher Education National Practice Leader, to get our town hall started.
Thank you, Pam. Really delighted to be with you all today. First, thank you for joining us for our first ever higher education virtual town hall. We plan on continuing this series in the future, so stay alert to those and look for those dates. For those of you that joined us last week, we apologize for the platform outage. We're working today and all looking great. We thought it'd be really good in this current environment and everything going on in the ever-changing compliance and issues surrounding higher education, not just as a result of the pandemic, but regulatory changes, to really take a moment and put this great panel of resources together that are higher education folks to go through some questions that we're frequently getting or that you've submitted. So I'm going to go ahead and introduce the folks that we have here today. So Laura Roos is with us today. She's an audit partner, and we'll be going through some questions on the technical side of the house. Actually, all of these will be technical, but the accounting side of the house. Tammy Erickson, also an audit partner, will be covering the GASB side. Matt Parsons is an assurance senior manager, and he'll be talking through some of the federal pieces as well as he'll be going through those as well. Matt Dinsdale is an assurance senior manager, again, covering some of the compliance pieces related to federal awards. And last but not least are our two tax experts that we have joining us today, Lauren Haverlock, who is a tax senior manager. She'll be covering some of the tax exempt issues as well as some of the regulatory changes. And Seth Dorn, who is a tax senior manager, and he is our resident state and local tax expert to go through some of these issues. I know that we have received a great deal of questions in advance that we're going to be covering today. Please use the Q&A on items we haven't covered or you'd like to hear about. And in addition, either the questions you've submitted in advance or the ones that are submitted today, if we are not able to get through them and cover them today, we will circle back with you personally to go through some of that. So without further ado, we're going to get started today and go through some of the questions. We're going to start heavy with tax and kind of work towards accounting specifically. So Seth, I'm going to start with you because I feel like this is the current issue and every day there's something else that pops up. So the first question we've got is, oops, I've got employees that I just found out have actually been working in another state, but I've been withholding in California and they're sitting in Florida. What do I do about that now?
Yeah, thanks, Melissa. It's definitely been a hot topic with COVID, and it's accelerated how many industries have remote employees. It's been an issue for a long time, but now I feel like everybody's feeling it. And it gets fairly complicated when you start having multiple jurisdictions, about where you should do the withholding. Every state has its own rules. Some of them have sort of a de minimis threshold or reciprocity agreement with another state. And so that analysis can get fairly nuanced, but as a general rule, you should be withholding and paying payroll taxes based on where your employee is working. And so in the case where you've, maybe since COVID, your employee has moved out of state, but you've continued to withhold in their kind of primary state, There are mechanisms to rectify that, to get money back from one state and get it remitted to another. That's pretty administratively burdensome sometimes. I think it's important to keep in mind that these are the employee's taxes. So you can go through that process, but you would typically have to refund that money back to your employee. The other option, and sometimes this is a little more practical, and we could, talk about some of the details that you would want to look at. But another option is for that employee at the end of the year, when they file their individual income tax, they would just kind of true that up on their resident and non-resident state income tax returns.
Wonderful. You talked about reciprocity between particular states or agreements between particular states. Why don't we have one rule for all of it, and why doesn't the federal government have a rule?
Yeah, good question. There has been legislation that's been put forward for actually a number of years that would give one blanket rule across the entire country of there would be a de minimis 30-day rule that basically says you don't have to start withholding for your employee until they've worked in a state for 30 days. Some states already have that, but it varies from state to state. And so that has been out there. It just has never had the political backing to pass, and they've actually folded that legislation into the new stimulus bill, but we have to wait and see if that'll actually pass. So as it stands now, we have to actually kind of look state by state to see what those requirements are.
Okay, perfect. Well, thank you, Seth. I appreciate that. I think we have a couple questions that have come in. I'll circle back after a chat with Lauren that
Right.
on those specifically. But Lauren, kind of along the same vein, thinking about employees, thinking about payroll. There's so much going on with the payroll tax deferrals. So what are the options out there, for employers to do? What do they need to do when it comes to payroll deferrals and with the new act and everything?
Yeah, that's a great question. There's two different kind of areas that we look at with payroll tax deferrals. The first one came with the CARES Act, and this is for employers to have the option to defer the Social Security portion of the employer payroll tax. That's 6.2% of your employee wages that is remitted to Treasury with the filing of your Form 941. That option allowed employers through March through December to just not remit that amount. Keep that basically as an interest-free loan. Then the remission, you could remit that, or you're required to remit that rather, 50% on December 31st, 2021, and 50% on December 31st, 2022. We've had various, it's optional, we've had various organizations that we've talked to anecdotally that take different stances on this. Some have said, yeah, because it's not we have to pay it back. We're not going to go for this. We're doing okay. We can, keep that. And other organizations have said, this is great. This helps our cash flow right now. And so we're going to take this option. Originally, that wasn't available to organizations who got forgiveness under the PPP, but now it's available to all organizations. No requirements relating to restrictions on, changes, gross receipt issues or shutdown of just anyone could take that. The other thing that was a little bit more relevant recently was in early August, the president issued an executive order that basically provided this assistance to employees as well. So employers had the option to defer the payroll taxes. What about employees? That executive order basically issued a notice to Treasury to say, hey, let's help the employees out and give them the option to defer their payroll taxes through the last quarter of 2020. That created a lot of confusion with organizations. This would have been in effect as of September 1st, 2020 through December 31st, 2020. We had received some subsequent guidance from the IRS that basically said this would have to be repaid in 2021, the first 4 months of 2021, ratably. So any employee that decided to defer would have to repay that in 2021. This is the employee portion of the Social Security tax. They're 6.2%. And the mechanics behind it were very confusing. But at the end of the day, the IRS guidance made it seem to indicate that this is optional. So employers are not required to do this. As of right now, what it seems like is as an employer, you're not compelled to do this. If you have an employee that wants this option, it's not something that you have to do. A lot of this falls to the employer. So if you have an employee that wanted to defer and then they left employment, and, before they were repaying it, it was the responsibility of the employer to pay that back on behalf of the employee. So it created a lot more issues. Anecdotally, we're not hearing of a lot of organizations that are actually providing this option to employees, but we are seeing that there are various ways of communicating this. Some organizations aren't communicating to their employees about it. They're just, memorializing this internally and moving on. But some are communicating and letting them know either through managers or directly that we're not going to be providing this option to you. So it's kind of a personal organizational choice when it comes to that.
Perfect. No, I appreciate that. That one's been confusing and snuck up on us too.
Definitely.
Kind of a follow-up question, and along the vein of COVID-19 and the pandemic specifically, I think too, if I can bifurcate this question, the first piece of it would be, speak to me and speak to this group a little bit about the cost of setting up a home office and what do I do with that as an institution of higher education? And then what else can I do to really support my work from home environment and folks that are in the work from home environment and just what's going through? What are a couple tokens, I guess you could give folks here to really boost morale, keep everything going, positive? What are the tools in that, if you could speak to that?
Absolutely. One of the interesting things that happened with COVID-19 was that it was declared a national emergency, and the IRS followed up and basically lumped that into a disaster. So with this, that kind of opened up the floodgates of Section 139, disaster relief assistance. And this is something that allows employers to provide tax-free relief and assistance to their employees. Typically, anytime you give your employee money, gift cards, anything, it's technically taxable income to that employee unless it meets a certain fringe benefit exception. But this Section 139 allows employers to provide relief related to COVID-19 to their employees outside of their taxable income. So it would be basically a benefit that's not taxable. This would have to be something that could be a variety of things. It could be reimbursements for housing issues that they might have, or helping childcare, people dealing with virtual schools, office supplies at home, setting up a home office, desks, or, chairs, things that normally a business wouldn't pay for an employee. This can be done. It can be done tax-free. It can be done outside of your expense reimbursement, your accountable plan, your expense reimbursement policy. It's not recommended that you have a written plan for these types of reimbursements, but you might want, as an employer, if you're thinking about providing benefits like this to your employees, you might want to get some sort of certification from them that they're using it for disaster assistance, for COVID type assistance. There are also certain things, we're seeing a lot more organizations looking at doing PTO donation programs to help employees affected by various results of COVID-19. This is something that can be done, normally if you have employees that are dealing with illness, but it also applies to nationally declared disasters. So a PTO program, PTO reimbursements can be given to employees that are impacted by COVID-19. You want to make sure that you're setting this up properly in accordance with the IRS's guidelines relating to PTO reimbursements or PTO donation payouts. You don't want to have employees directly giving to other employees. You want to hold it within a bank. You want to make sure you have a written document and plan in relation to this. But it's something that you can look at doing, and it's a way to have employees be able to donate their PTO basically tax-free. Usually PTO, when taken, is a taxable event for the employees, but they can give it tax-free. They don't get a deduction, but they can give it without incurring tax on that. And employees who get it do have to pay tax on that time that they're taking, but it's, allowing them a little bit more benefits in that area. There's a lot of other things too. Tuition reimbursements are permitted in 2020 related. If you have a tuition reimbursement program, you can reimburse student loan payments. And so there are a lot of things out there to look at to help your employees.
Thank you so much, Lauren.
No
and
problem.
then one that came in, and I know you and Seth are not necessarily international only. I know you deal with a number of international issues. But one of the questions that came in, so it is international students working from their home country. Do we pay them out of payroll, even though they may not have a valid social security number? Is this through accounts payable? So basically, is it a W-2? Is it 1099? Is it something else? What do we do with that as an institution of higher ed?
Well, it depends. That's our typical tax answer. It depends. And this is something that you do want to look at it. It's important to, first of all, know the tax residency of that person that you're paying. Are they a U.S. tax resident? Do they have a passport or green card? Do they have substantial presence in the United States? Have they been in the U.S. for a certain amount of time that could bring them into, somebody who's taxed in the United States? And do they have residency in that country that they're working in? If they are a U.S. tax resident, you likely would have to, provide a W-2 and do withholdings from a federal perspective. There could be state issues too. They also might have the same requirements for filing if they're working and earning that income in another country. You'd want to get information from that employee about where their residence is, and that you want to make sure to get a W-8 BEN issued to them to understand if there are tax treaties or other implications. But it's possible they could have withholdings in both their home country and the U.S. There are certain ways to offset that double taxation in the U.S., but it's something that you want to make sure to document and follow up on and learn a little bit more. If they are providing services as an employee, they likely wouldn't be considered a contractor. So, that's something to consider. There's also other considerations of, and having an employee in another country, do you create a foreign branch in that country, and do you have other requirements of filing there? So there can be a lot of issues that happen if you do have an employee working from another country. You would have to look that up, and we definitely advise people to reach out to your tax people, and we'll get you in touch with someone who works in the international reporting area. But I've been on many calls, so I've learned a lot over the past couple months because this has been more and more of an issue.
Yeah. One last question that just came in, and I don't know if you can see it, Lauren, but related to cell phone and connectivity stipends. Does that fall under 139?
Yeah, definitely. This is something that we're seeing falls under 139. It would probably fall under a normal business reimbursement anyways if an employee is working from home, but I think you have a little bit of additional leeway in that 139 because that is something as a result of COVID, people, using their cell phones and people using home internet connections. And so providing reimbursements is something that would be required or could be done. In some states, it's required. California does have a law that they passed that requires employers to reimburse employees for their home internet and home office connections. So that's something to definitely note of an issue here in California. I know we have people from all over the country here, but I can imagine there are similar requirements in countries too, and in other states too. Sorry.
Perfect. All right, tax folks, I'm going to let you off the hot seat for a minute, and I'm going to switch over to our compliance folks. Great questions. Thank you so much. I'll start kind of broad and work my way down on the compliance side. So Matt Parsons, we are still sitting here today waiting for the addendum or the second phase of the White House Office of Management Budget Compliance Supplement, whereby we as auditors use as a guide. Any updates on that and what's going on?
Yeah, great question. So first, I'll just take a quick step back and answer, what is the compliance supplement and why is it important? So the supplement is issued by the White House under the Office of Management and Budget, and it identifies all the existing and important requirements that the federal government expects us to be considering as auditors when we're actually conducting the single audit. And it's actually referenced in our auditor's report in the uniform guidance. So it is pretty critical. And the 2020 compliance supplement really only relates to grant recipients with years of June 30, 2020 and later. So just keep that in mind. And it was just recently issued on August 14th, 2020. So much later than a lot of our planning for engagements has already started. So just keep that in mind and why we're having a lot of changes that we're developing now as we're going through our testing. But unfortunately, the supplement was not updated to incorporate the requirements for testing all COVID-19 funding programs. And at this point, we have not received confirmation of when that addendum will be issued. This is partly due to regulations which will define testing requirements, which are still under their commentary periods. I think September 30th was the most common deadline. So hopefully we're nearing that conclusion now, for example. And then, getting back to the question of, how this impact audits. So potentially for organizations that received significant funding from COVID-19 that was expended before the year end, it could result in delays to the issuance of the single audit reporting package until the addendum is actually issued. and that includes the Education Stabilization Fund, which provided the Higher Education Emergency Relief Funds. So just another important note is that on the schedule of expenditure of federal awards, all COVID-19 related funding needs to be identified separately with a prefix to the program name. So that's a pretty important thing to be aware of. The supplement also includes, like an example, for example, the TANF program, where if you've previously recorded expenditures under that program in the past, you would actually break out the COVID separate funding on a separate line item. So just make sure that you're aware of that and talking to your auditors and your accountants. And then currently, the most recent memorandum that was issued on June 18th, 2020, M2016, any single audits due for fiscal years after December 31st, 2019, no extensions for filing have been granted, which is unfortunate. We're hoping that will change in the future. So right now, the expectation is that your single audit reporting package will still be due within 9 months of your fiscal year end, unless we get any addendum is finally issued.
Great, Matt. So that's perfect and incredibly helpful. Are there a couple tidbits in the first, I'll say, compliance supplement without the CARES Act pieces to it that were changes that we're dealing with right now that folks on this call need to know or should be expecting as part of their audits?
Yeah, great question. There were a few surprises that we received, especially over the student financial assistance cluster. So firstly, if you're an institution that's on the heightened cash monitoring payment method, there's additional testing requirements to ensure that any credit balances that exist on a student account have been paid prior to requesting or drawing down other funds from the Department of Education. So I know it's probably most institutions are used to us testing credit balances in the past, but if you are on the heightened cash monitoring payment method, there'll be a little nuance there. We'll be looking at different population and testing additional accounts. Secondly, historically, auditors have been required to test Title IV funds. That's no surprise. But the compliance supplement specifically added clarification that auditors should also be including leaves of absences and students that never began attendance in their populations for testing. So again, probably won't have a significant change, but just if you're getting those additional requests, just know that's the reason why. I believe it's really mostly to understand the completeness of your student population and making sure that we're getting the right students that we're identifying and testing to begin with. And then probably the most challenging requirement that's come out has to do with how permanent address changes are being communicated to the National Student Loan Database System. We understand that many institutions don't have the ability to track this information on their own. Or if they have information, it's not necessarily the permanent address, it's any kind of change to their address. So we'll have to navigate a way to understand how the information is collected and transmitted, and possibly testing students that were identified in other samples to make sure that their permanent addresses on record agree to what's been reported to NSLDS most recently.
Great. Thank you, Matt. Appreciate that. So I'm going to switch over to the other Matt and talk a lot about some specifics. So I received CARE funding. So how do I know if this needs to go on the CFA or not? And what do I need to do if I'm in a business office's shoes and I'm putting the schedule of federal awards together? How do I check this? How do I know what needs to be in there? How do I know how to label the preface, prefix? How do we do that, Matt?
Yeah, good question, Melissa. Thank you. Sorry. Okay. So just a reminder that the CFA is on an accrual basis. You're required to report when the actual costs are incurred. And most people recognize it as a schedule that reports expenses. And with the CARES funding, not all the costs that are going up there, or not all the amounts going up there, are actual expenses. You have student disbursements, which are typically recognized when the disbursements are being made. So under the HERF funding, you'd recognize it when those disbursements are happening. And that's when they go on the CFA. If there's foregone revenue, for example, if you've refunded housing, food, other services incurred after March 13th, that would be recognized when that refund is actually issued to the student. And obviously, some other expenses would be incurred and are allowed to be reimbursed under the CARES funding, and those are typically just shown on the CFA as they're incurred on or after March 13th, 2020.
Perfect. Thank you, Matt. I appreciate that. Hopefully you guys can see and hear me. It's slowing a bit. Can you speak, Matt Dinsdale, a little bit about the reporting requirements for the CARES Act and what I need to do as an institution of higher education with that?
Sure. So Matt Parsons mentioned the CFA and how that's reported and the requirement for you to actually identify those COVID funding on the CFA separately from others. So there's also some other reporting requirements that are not related to single audit. So there was a requirement to report a 30-day fund report, and that was within 30 days of receiving the actual funding, you're required to report back to the Department of Ed. There's also a separate reporting requirement. Actually, there was a recent email blast that went out from the Department of Ed on this, which requires higher education organizations to report on their website every quarter. And there's a number of different items, I think 7 items that are required to be included there and updated frequently, about quarterly. And there was a form that was put out along with that email blast that helps compile that information and organize it to allow kind of an organized display on your website. And it's supposed to be there up front on the website. It's supposed to be easily found and easily identified by any individual going to the main website for your university.
Okay, perfect. And I think there was some other follow-up stuff, Matt Parsons, that came in on some of the requests, or maybe it was something specific. I know that there was really talking about how you spent it, not when or how much. Could you speak to that a little bit and kind of some expectations we're seeing on that side?
Yeah, so there's been a lot of debate over the 50% threshold. I think is that what you're referring to, Melissa? For the refunding?
Follow-up questions on the reporting, specifically not the 50-50, but the what?
Oh, the COVID. Yeah, so on the CFA itself, there should be a COVID-19 prefix before the CFDA number. And so I know there was a question about whether your accounting system needs to actually reflect that same breakout. I don't think it's required by any means, as long as you have a tracking mechanism to be able to pull the information so you're reporting it correctly on the CFA.
Perfect. Thank you. That's great. Wonderful. Well, thank you both so much. I'm going to move over now to really talk about the financial responsibility ratios. This is not new for higher education, but new in terms of the requirement from the Department of Education to include it in the footnotes to your financial statements or as a supplement as part of the, to footnotes to the schedule of federal awards. So this is something that everybody's going through right now, dealing with. There's, of course, no prescribed format. There's a lot of folks that are putting templates out there on what you should or shouldn't use. There are instructions specifically on how to do it. Art did a great job for the firm in kind of leading this group. So I'm going to have Art. Maybe Art, you can speak a little bit about it. And then I guess there's some questions as it relates to some of the lease standards as well. But maybe you can give just a quick overview on the financial ratio responsibilities. And then if you could speak to us about any ability to opt out on post-lease implementation issues and the effects of those on the financial ratios, and what we can and can't do if I have adopted the new lease standard, if I have not adopted the new lease standard, those sort of things that would be impacting these ratios.
Of course. Thank you, Melissa. So first, I'll talk about the new responsibility ratios, or what was revised. So with the new standards this year, 3 key ratios are calculated, they're weighted, and then they're combined into calculating a composite score, which is all required to be disclosed in the financial statements this year. As Melissa said, there's no prescribed place to include in the financials, but what we're recommending is to include in the supplementary information. So there is going to be some information there showing how the ratios are calculated. It's also going to show the different key ratios for the composite score. So the 3 key ratios are the primary reserve ratio. There's also the equity and the net income. If you go into the NACUBO's website, it talks about what information is included in calculating these ratios. So if you want to take a closer look at that, you could access the NACUBO guide. There's a lot of good guidance with how that's calculated and how it's different from prior year. And then to answer Melissa's question, she asked about leases and whether or not you could opt out. So it isn't mandatory for organizations to, I guess, early adopt the new lease standards, so they can adopt or they can opt out of, I guess, presenting whether or not to present the key ratios under the new lease standards. So if you do decide to opt out, you do need to disclose that in the financial statements, or if you don't, then the Department of Education, they'll assume that you are opting out. You don't have the option of, once you decide that you're either opt in or opt out, you don't have the ability to go back and forth between opting and opting out so that you can improve your ratio. So you have to pick one method and then just go with it.
Perfect. That seems pretty typical, right?
Mm-hmm.
No, stick with what your policy is, right? And don't change it. Perfect. Another one that's a little bit tricky, right? So if I'm an institution of higher education and I've refinanced my pre-implementation debt, in that refinancing, I've incurred issuance costs or other costs that I'm going to amortize over the life of the debt. Does this increase my pre-issuance debt in a way that I would lose that status, or is this considered post-implementation debt? So could you speak to that specifically?
That's a good question. So when you have refunding debt, you are not supposed to include issuance costs. So you're just only looking at the proceeds that you get from the refunding bond compared to the old bond. So anything in excess of that is included, but you would not include issuance costs related to the refunding bonds.
Okay, perfect, excellent, very good. I will move on that back over. And I don't know, Lauren, you got a couple questions that came in on tax. And I think for the benefit of this group, do you want to speak to those questions and the answer you gave? Or I think it might be helpful to share that.
Yeah, the one that I saw that came through, and if there's another one that got cleared, but the one that I saw that came through was just confirming that when you do have cell phone reimbursements or connectivity reimbursements, then would those be taxable income or not? And they would not be taxable income. They would be reimbursed like any other type of business expense. If somebody had a business mileage or something like that, this is these connectivity reimbursements. If you want to do $100 a month or some blanket amount that might cover it, you can do that. And it's not even required that you obtain receipts for these types of reimbursements. So you wouldn't need to go to your employees and say, hey, can we have a copy of your bill or a copy of your cell phone statement just to make sure that you have these. You can provide that blanket amount with some sort of understanding and maybe like a certification from the employees that in accepting it, they are using it for connectivity or business home office reimbursements. So it wouldn't be a taxable benefit. That's the thing without this 139. And there is a listing, if you find I think Moss Adams has an article online about this, about some of the things that some of the options that you could provide to employees that might be facing various types of issues, childcare issues. I mean, even reimbursements for mental health support or something if somebody's, struggling, those can be done tax-free. And that's one of the great things about this is you can provide some assistance to your employees and, save yourself some money by not having to pay the payroll taxes surrounding it, and save the employees some money. They don't have to pay any income tax regarding it too. So,
yeah. Perfect. Thank you, Lauren. Art, back to you. Sorry, you're not off the hot seat yet. So one of the questions that we did come in for you is related to formatting. And I kind of alluded to this in the beginning. I think the Department of Education didn't really prescribe to anything specific. They gave requirements, right? So we're all interpreting in the display of it. And so one of the questions we had was, if I follow the lay of the law, do I need to put zeros in? Do I have to have empty lines? Or can I only have what I have specifically? So for example, if I don't have any long-term debt, do I still have to have a long-term debt line? That sort of thing when you're putting the financial ratios together in the display options. And then I guess secondarily, we didn't really hit on this, But could you remind folks on the requirement? Do I have to put this as a footnote to the CIFA, actually in the narrative? Can this be a supplemental schedule? So I guess if you could address those two questions from a formatting standpoint.
Okay, thank you. So Melissa is right there. It's not really prescribed of how to present it. So if you do have zeros or if you do have line items where you don't have a balance this year, there is some flexibility. It's really up to the college or university's preference whether or not to include those line items and just show zeros. We've seen it both ways. Some of our clients like removing those zero line items, but some clients like including it. Just in case there's a balance, down the road, they'll have that line item there. So there's really no set guidance of, what line items should be included and whether or not to show zeros. And then as far as where to include these include these schedules, again, it's not prescribed. We are recommending that it should go into the supplementary information with the uniform guidance or the CIFA where that's presented. It's just because it goes hand in hand with the student financial aid. So that's why we're recommending that these schedules are included with the supplementary information. You do want to make sure that any financial information that's used to calculate these ratios, it's either included in the footnote or somewhere in the supplementary information. The U.S. Department of Education is very clear that it has to be presented either in the face of the financial statements or somewhere in the footnotes or maybe in a note to the financial statements showing how these numbers are derived.
Great. Thank you, Art. I really appreciate that. Okay. Thank you, my federal compliance people. I'm going to move on from you at this point. Thank you. Unless we get any other questions, I reserve the right to come back to you. Moving on to the accounting side of the house. So I'm probably going to ping pong between you, Laura, and Tammy, because you have similar questions, but obviously different reporting and accounting standards to follow. So I'll start with you, Laura. I've got a PPP loan and I got it in May. I've got a June 30th year end, and it hasn't been forgiven yet. What are my options for reporting it as of June 30th and the way to account for it?
Great. So not-for-profit organizations have two options when it comes to the PPP loan. You can either record it as debt, and so put a liability on your books when you receive the cash, or you can evaluate it as a conditional contribution. So if you choose the option of recording it as debt, then you have footnotes like you would as it relates to debt, and you would record when it gets forgiven, you would remove it from your financial statements. It would be a gain on forgiveness, but not until you're legally released. So that means you'd need the information back from the bank saying, hey, it's forgiven. If you go the conditional contribution route, which is another option, you would record an obligation when you receive the funds, maybe in advance or something like that. As you evaluate your expenses at the end of your year, whether it's probably a June year end, you could evaluate, have I met some of the requirements? Have they met the barriers? Have I incurred expenses? What have I done that might allow me to have forgiveness? If you got over that hurdle, then you could record a contribution, an unconditional contribution, because you've met those conditions as revenue. Or you may say, hey, I really feel strongly that submitting the application to the bank is a condition. So you have a little bit more flexibility with that one. I think the most important part is disclosing what your thought process is in your footnotes to the financial statements.
Perfect. So Tammy, on the GASB side, anything different on the revenue side of the house than what the FASB folks are doing?
Yeah, so GASB is a little bit different. GASB has some very specific guidance, where FASB, you have these standards that you can determine what you fall within those standards. GASB is much more direct. GASB 70 actually does show that as a loan until they are legally no longer liable to pay that loan back. So they are going to actually have to wait until they've been released from that debt in order to show that as revenue. And so they'll show that as a liability, disclose it as such. Again, as Laura said, the disclosures are really important. I'd make sure that you PPP loan and that you are submitting an application and that you do anticipate that it may be released, but until that point in time, they're going to have to show it as a liability.
Perfect. And so on the flip side of that, I'll stay with you for a second here, Tammy. So I've spent the money, right? So I've given the grants out to my students. So let's say Part A, right? Give the grants out to my students. Yeah. Part B, I've either reimbursed myself or I spent money on COVID-related expenditures. How do I present that in a GASB financial statement? What is this operating? Is it non-operating? What can I do on a GASB statement?
Yeah, and again, I think GASB is probably a little bit more, has more guidance out there. So the expenses themselves would be operating expenses. There's part of the operations of the university. They're giving out student aid for the Part A portion, and for the Part B portion, they're incurring institutional type expenses. They would show the funds as a liability until those eligibility requirements have been met. So they receive the funds, they're going to record the cash and the liability. And then as they send those funds out to the students, at that point in time, then they would record the revenue for that portion, but that revenue will be non-exchange transaction. The university is receiving the funds and they're not giving anything back to the federal government to receive those funds. So the revenue piece is going to be non-operating, while the expenses will be operating. For the Part B portion, of course, they have to first give the funds out to the students. Once those funds have gone out, then they can recognize the other 50%, that matching percent, for the institutional side. And again, once those eligibility requirements have been met, so they've incurred the proper types of expenses, then they can recognize that as well as non-operating revenue.
So I can't show it as extraordinary?
Unfortunately, no. That's another area. There have been questions about that. In order for it to be extraordinary, it really has to be infrequent in occurrence and a type of an event that you don't reasonably expect it to reoccur. Well, things like this, unfortunately, do occur. Maybe not to this extreme, but people come down with the flu and such. And so it's not considered extraordinary. The other question that sometimes we've had some clients ask is whether they can show it as a special item. Because sometimes you'll have that in GASB financial statements. But again, that's something that you cannot do because special items have to be something that is within management's control. And obviously the pandemic is not within management's control. So that's both GASB 62 and also GASB 34 kind of provide the guidance on those two kind of topics. So unfortunately, they're going to have to be part of your operating expenses.
Okay. Makes so much sense.
Yeah, right?
Exactly. So Laura, I know this was something I'm putting you on the spot, so let's flip that on to the FASB side. And I know that Nakubos put out some documents on this, and Jeff Mechanic spoke to us a couple weeks ago about this specifically. What does FASB think about the expenditures and where these expenditures go as it relates to a FASB reporter?
So, Nakubos' first guidance came down to the Part A and Part B, right? And Part B, there were two different perspectives that we could take. Well, maybe we didn't get all of our disbursements out to our students, but we've identified who they are. Can I really recognize as revenue some of my Part B expenses that I have incurred? I got my institution up to speed on internet. I moved my employees off campus. I did all of those things. And this funding is a conditional contribution. And even though Nakubo provided guidance that said, perhaps you could look at these Type B expenses as not having a barrier, FASB and the Nonprofit Advisory Council, it wasn't last week, it was right before our last opportunity to do this, really came down and said, you're really taking a risk. There is a barrier there. You probably haven't earned those, and they shouldn't be recorded as revenue until you have met the obligations under Part A, making those student disbursements. So I always like to think about materiality to your financial statements. It seems a little weird to have expenses in one year and record revenue in the future, but that's why we're all accountants. We love this stuff. So we'll have to explain it to everybody who's reading our financial statements. So
great. And thinking about what Tammy addressed on the operating versus non-operating, I also know Nakubo had some article out specifically on this too. And again, Jeff Mechanic kind of went through, ASC 958, and it doesn't really talk about, you get to define your operations, right? So maybe you can talk a little bit about, is this operating, non-operating, and what do I do as an institution of higher ed with this?
Yeah, well, when we think about what the funds are for, right, and it is a contribution, and I think you have a little bit more flexibility. If you are recording your expenses out to your students as an operating expense, then it would make sense to record Part A as a contribution and operating up in your operating measure. When you're taking or earning your revenue for your lost housing and other expenses, that would have been above the line or in your operations measure. So if we were in the same period, it would seem reasonable, right? Hey, I'm going to recognize the contribution for my lost revenue, my student revenue, and that number, the tuition revenue would go down, but then I would have a contribution for the difference. So that would make sense to have it up above. I think, again, the guidance for FASBs, we're a little bit more principle driven. So define or disclose what you've done, and you can probably support whatever's best for your organization. A lot less specific than GASB.
Document. Agreed. No, absolutely. So as it relates to this, I think, the silver lining in this pandemic was the Financial Accounting Standard Board was really, I guess, empathetic, I'll call it. And so, Laura, maybe you can speak, and I think most folks on this call know, but just as a little bit of a reminder, what did they do to really help us out this year, especially our public institutions and, those public entity institutions that would have been up for some of the standards this year. Can you speak to some of the deferrals specifically?
Right, sure. We did take a little bit of, thought about us accountants and how successful we would be in implementing a new standard. So our public institutions didn't have to apply the lease standard, which would have been effective for May or June or July year ends. And so we got a deferral as it relates to that. However, we did not get a deferral as it relates to the contribution standards, 2018-08. So that we've recognized our revenue recognition last year, but that standard was you're not allowed to defer that. So that had to have been implemented this year. Some institutions applied that last year when they implemented the revenue recognition standards. But now for our non-public entities, right, they got a deferral as it relates to revenue recognition, but they didn't get the same deferral as it relates to 2018-08. So you could have pushed that off a year. And another deferral was the lease implementation standard that was going to be effective for this year. We got another year for public institutions and 2 years for non-public institutions. Don't put it off. That lease standard is complicated. It especially when and maybe leases will start going away, but it's really important to take the time that you can and start implementing or at least inventorying your leases, find out where they are, run your rent expense accounts, your lease expense accounts, any other types of expense accounts or in your general ledger to help you identify where you might have these leases sitting around, and at least that can get you a head start. And one other suggestion I would have is really looking at your capitalization policy. If you're going to end up having to put a lease on your books, you'll probably put a lot on your books if you have a $2,000 capitalization policy. Really think about, do we really need to capitalize all these things if at $2,000? Could we go to 20? What's that threshold? So start thinking about that. It's an option for you as you're implementing this standard.
Yeah, perfect. Good. Those are good lessons to think about and getting prepared. Anything else on kind of lessons learned and those that, we've got some of our institutions that are want to always be best in class and the first ones to adopt, or they've agreed in a conference that they're going to be the first to go, right? They're the guinea pigs. So any feedback you've heard, or for this group, just the couple of tidbits, and it could be anybody on this call, to be honest, just a couple tidbits on what not to forget when really thinking about adopting leases.
I think in embedded leases, looking for agreements that might have those other things that might not say lease in them, but they are an agreement for services. Start early. Maybe start with the footnote or the journal entries in mind to at least help you think about what the full impact is. And I think letting your stakeholders know who else is using your financial statements that really cares about new things being recorded in the financial statements. So if you have a lender that may not be aware of this new standard and what the impact is on your financial statements, getting them on board. I'm sure there are others, Matt or Tammy, who have had clients too that might have some suggestions.
Any other suggestions? Yeah.
I'll just add real quickly, I know the incremental borrowing rate has always been a confusing element to the lease standard and how you determine it, how is it calculated. There are some simplifications that were allowed for non-public entities, so just be aware that those do exist. So for example, if there's a treasury rate that makes the most sense, or another interest rate that you have comparable borrowing on that might be used, just talk to your accountant, talk to your auditor. They might have some ideas of some good reference points to think about when you're going through that assessment. And then finally, just a reminder that any past operating leases, you don't need to go back in the beginning of time and recalculate this. It's basically at the time you're implementing. So it's a key element. So you're not pulling your hair out, going back to the beginning, figure out what every single lease term was and how many years outstanding you had from the onset.
Yeah. And I would say too, some of my, I think, really proactive financial officers have gotten in front of their audit committees or their finance committees early on with a pro forma presentation. Here's what it's going to look like. Here's what to expect. So I think thinking about that in meetings before you get to the annual financial reporting or the delivery of the audit results is really important too, especially if you have something significant. Obviously, if it's not significant, not a huge issue, maybe some dialogue discussion, but I think giving a visual when it is highly impactful, if you have a lot of international leases, if you have a lot of satellite leases or off locations, or even leasing, obviously dorms. So definitely something to think about when you're trying to prep not only yourself, but those that are using the financial statements, and it would expect those changes. I think those are all very good. Perfect. I think we had one last question, and I will close with this, and we'll probably end a little bit early today, but if anyone, I'll give a last call. If anyone else has any questions, please submit them as we'll be closing out. I think this has been a really great session, and thank you for everyone who did provide any questions. I think the one question we get, and we get it a lot, honestly, when we're presenting to our audit committees, is related to consolidations. What are we seeing as a result of this? I think you guys have seen a number of reports that have been out there on who's going to survive, who's going to die, who's going to thrive, and some statistical surveys that are out there on what's going on. And, we're already seeing specifically a lot of merger activity, especially in some standalone small institutions. And I think we're going to continue to see that. And it's going to, really is going to be heavily dependent on what happens in spring. And it's state dependent on what the states are doing specifically as well. Know that we do have a mergers and acquisition article coming out very shortly. We will be addressing some of this and some of those things to think about whenever you're either being courted for a merger or you're seeking a merger, and some things to really think about. So that article will be coming up. We also do have another, webinar coming up on this too. We also do have a webinar on lean and sustainability coming up, just a little bit of an advertisement. We didn't talk a lot about cash flow and sustainability, but we do have a group in Moss Adams that works on that, specifically in higher education, and they have a webinar this fall coming up. So we'll encourage you to obviously listen to that. So look for those alerts. We really appreciate your time today. I want to thank again our presenters who did a fantastic job today in going through this. With us. I know that everybody is busy, including our institutions of higher education. We're all getting through our audits and our annual closes. So thank you so much for taking the time to join us. For those of you on the West Coast, for sharing your lunch with us. If you have questions, you can always reach out to any of the panelists directly. You don't have to do it, obviously, through this forum. Please visit our Moss Adams COVID pages. We have very specific landing page that goes through these. You'll find links to our slide decks, our handouts, our alerts that have gone out on this specifically, and there will be a survey to follow up. My request here is please send your feedback. What do you want to see or hear different? What would you like us to do next time? Or what are some of the topics that we could really hit on? So again, we got some really good updates, as well as an accounting and audit update that's coming up shortly for FASB reporters specifically. So that is coming up. As well. So 3 relevant higher education webinars probably in the next month and a half for you to pay attention to, and a couple alerts, and as well as we will circle back on the next in this series for higher education. So good luck, everybody, getting through your annual reporting and getting through your audit committees and getting through all of your board meetings this fall. I know it's been a really tough year. We feel it, we see it, and we're right there with you. So thanks for taking the time today. We appreciate it. Bye, everyone.